It's Sunday, October 17th, 2021. This is all about your Benjamins and your weekly mixtape and weekend review video. And as you can see, we are not at home. Actually, currently at the soccer fields, waiting for Roman's match in Evansville, Indiana to get off. So I had to deal with the best I could with what we have, using the iPhone to get the video done, which means there's a black bar on the side, which really frustrates me, but I couldn't get the video to turn sideways, get the phone to stay the way it would be so it'd fill your screen. So we'll be back next week with normal video quality, but most importantly, we're going to get to the headlines that may or may not be impacting your financial plan and portfolio. And as you can see down below, we have a handful of headlines. The first few all center around inflation. So we're not going to spend a lot of time here, but we constantly talk about inflation on this. The Fed's looking at it. What does it mean to our pocketbooks? What does it mean to our ability to buy and spend and pricing going forward? And what does that potentially mean to the economy in the future? So we can see that there's accelerating spending, as the first article shows. In September, consumers were out continuing to spend, putting money into the economy, which is a good thing despite prices starting to raise. The second article talks about how inflation is up over 5.4% year over year. So we're seeing that rise. Remember, 2% is the goal for the Federal Reserve. Now that 5.4% rise does not mean inflation's at 5.4. It just means that year over year it's up 5.4%. So you got to figure there's average out there. So we're seeing inflation tick up, which is going to play into what the Federal Reserve does as we've been following along. The bond purchasing program is going to be slowing down. Will they start to raise rates? What does that mean in the short term to the market, to our plans, and all those types of things? So as we continue to see this go, we'll have to see how things play out. Now, we've talked about it in the past, and I believe there's another article that tips on it about the supply chain issues. So you've probably by now seen the videos of the barges backed up in the Pacific Ocean, waiting to come in. Barges are out there for weeks with all of the things we want to be buying that are stuck on ships right now because there's just this issue of getting everything out and into the stores. Not enough workers, whatever it may be, lots of things going on, keeping those barges out there and the materials and the things we want on the ocean as well, which means short in supply. The demand is there, and Econ 101 says if there is not enough supply to meet the demand, then prices must rise to a new equilibrium, to a new place where it kind of settles out. So we've talked about transitory, that when this bottlenecking gets done, there's a flood of the market of those all these materials and goods that we want. Do prices come back down, or is this staying? When this comes off the boats, gets into the stores, do the prices stay where they're at? We'll have to wait and see. Federal Reserve believes that it's transitory, meaning that it will fall back down as the supply goes up, but sometimes a new equilibrium stays regardless of the supply. So we'll have to wait and see. So inflation is the big thing. Sticking with inflation, oil topped above $80 a barrel since the first time since 2014. So pay attention there as well. We've got rising prices in the store, rising prices in energy, and obviously energy kind of spills into gas as well. So seeing all those things go up. Will consumers continue to spend like they did in September? We're heading into the holiday season. We'll have to wait and see. Could be kind of a double whammy with the prices going up. Maybe consumers spend a little bit less. And if the things they want aren't there, will they go to other goods, or will they just hold off and wait till what they want comes? Maybe this will be a big year for gift cards. What you want isn't there, so you can buy a gift card. And to be honest with you, I haven't spent a lot of time researching what does that do to a company's bottom line. I believe they get to recognize the gift card sales in the year that the sale happens. So then that could play out in the future to bring their numbers down when people cash in those gift cards. If they only spend the $50 that they were given, then in the year that they actually spend it, the business may not be able to recognize it because they recognized it the year before. So maybe they have a year of lots of inventory going out, but not quite enough sales because it's a gift card's not going to it. So as you can see, these things, these events kind of spiral and kind of have, waves that go out further than just right now. It'd be interesting to see. Nothing to be alarmed about or panic about, but just something to pay attention to. All right, so three more things left to go. The border into the U.S. is going to be opening soon with proof of vaccination. So we're getting a little bit closer back to normal. People being able to come into the country so long as they can prove vaccination. Not a lot there, just kind of an interesting and good to see us moving back to normal. Interesting coming out of Walmart. Walmart is trying to build a fintech startup to bring financial services to the workers, and I've got to imagine eventually to customers as well. Being a financial advisor, we have been threatened that we're going to be disrupted by Amazon. What if Walmart did it? Those things. The reality of it is, I think that the services they're going to provide are going to be actually a good thing, because I think that they will provide services to people who aren't being served by financial advisors today. Even in firms like my own that has a lower ability to work with clients, subscription models, but still, even at $150 a month for a subscription model, they may be more than some people can afford. So if advisors do pro bono, but if you need some ongoing service, these types of services may not be a bad thing. Obviously, they're going to leverage technology so they can scale, which brings the cost of financial advice down. But I think that what they're going to be able to do with that technology from a planning standpoint won't quite be as in-depth of planning as an individual do, or behavioral counseling and those types of things. But helping with budgeting, maybe helping with some basic investing, I think those things are great, and technology can automate those, which is why financial advisors have been shifting more to advice, getting into the deeper planning, not just the budgeting and the investment. So I'm not threatened by it, but I think it's a good thing as it brings more access to more people. So I'm all for Walmart doing that. I trust that I will continue to do a good job for my clients, that even if their service is good, my clients aren't going to leave me for Walmart. And then the final, and this is an area that advisors can kind of come in, and I think technology can do some of this, but end of the year planning, I was having a conversation with a client about this, looking at FAFSA and kind of what will impact due to some investments they have. End of the year capital gains distributions, the projections will be coming out here pretty soon. So if you don't know what those are, if you hold a mutual fund and it is not in an IRA or a 401k, it's in a regular taxable account, every year those funds kick out what's called a capital gains distribution. So a capital gain is when you buy low, sell high. We can generate our own capital gains from the standpoint of, we buy a fund or a stock at $5, we sell it at $10, there's a $5 capital gain. If you hold it for less than a year, it's short-term capital gains, which is taxed at your income level. If you hold it longer than a year, it's a long-term capital gain, which right now is as low as could be as low as 0%, but for most of us, it's 15%. For those ultra-high net worth, it can go up to higher levels. And that's one of the things that we've heard President Biden talk about changing, as far as the capital gains taxes for those making over $1 million a year. But that has nothing to do. Another way that capital gains distributions come to be is inside the fund. So mutual fund again. ETFs are different, which is an advantage that ETFs have over mutual funds. Mutual funds, by design, by law, the way they're set up in the Investment Company Act of 1940, I think is what it is. It's been a while since I've taken those exams. They have to distribute all capital gains to all shareholders. Meaning, if the fund manager decides, hey, we're going to sell this fund, this stock, to buy another one because of whatever reason, or they are forced to sell because there's redemptions, all the investors want their money out. So in order to raise enough cash to make those distributions, they have to sell stocks. When that selling goes, if there's a capital gain that can't be offset by losses that are sitting in there, then they have to be distributed to all shareholders evenly. And that can kick out some significant additional distributions that we didn't really want, that we have to pay taxes on. So there is a date that you can get rid of the fund beforehand if you don't want the capital gains, but then you have to worry about, well, what are your capital gains in that fund as well? So working with your financial advisor, you can look at these, you can check the projections, you can see what it would be and plan ahead. But this is why a lot of times people have a little bit more of a tax bill than they thought they would, because these distributions are forced upon them. Now, way back when, coming out 2008, 2009, there were very few capital gains distributions for a while, because there's enough losses coming from the great financial crisis that could offset gains. So remember, losses can offset gains. We've been in a pretty good bull market for the last 12 years now, or maybe no more. I do my math, 13 years almost. So we've been on a pretty good bull market. There's probably not a lot of losses in there in a mutual fund to offset. So the gains are going to be kicking out. So you'll be able to see a range. They won't tell you exactly what it is, and you can do your planning from there. The article that references this also talks about charitable planning, but capital gains distributions is something that I don't think a lot of investors are aware of. This is why ETFs held in a non-retirement account are more favorable. ETFs by design do not have capital gains distributions the way that mutual funds do. So you can minimize your tax bill just by holding ETFs outside of a retirement account. Inside the retirement account, it doesn't matter. All these things are deferred, so no big deal. But if you have money invested in a non-retirement account, a joint account, an individual taxable account, then these cap gains from the mutual funds are going to be coming, and you can plan ahead if you need to, or just be aware of them. All right, that's it. This went a lot longer than I thought. So again, apologize for the black bars on the side. That really bothers me, but got to work with what I have now. The camera wouldn't sit in the car in a way that I could see myself without the steering wheel being in the way. So this will work for today. So as always, thank you for tuning in. Be sure to check the mixtape down below. It's a little shorter than usual just from a timing standpoint of we drove down to Evansville yesterday. We stayed the night. We got the game here in about 15 minutes, and then we'll head back up. So I'm going to finish this up while we charge on the way back on the way. So thanks for tuning in. As always, feel free to share, like, comment down below, and have a great week, and we'll see you all in the next episode.